Welcome everybody to a very new Friday series that I will be starting every week going forward here called Positive Theta Trade Management. I'm your host Bull, one of the founders of Portfolio Kings, and in this video series we will be going over the different trading styles, techniques, strategies, and data that result in a net positive theta in our brokerage accounts, which means we're making money every day as time passes. If you're new to the channel, please leave a like, share, and subscribe. Without further ado, let's get right into this. To start off the series, in this video, we'll be going over calendars and diagonal spreads, how to have a directional bias with time decay working in your favor. These are some pretty simple option strategies. They're very similar, so let's get right into these strategies and see what they're all about. What is a calendar spread in options trading? A calendar spread is a combination of a short call or put at a closer dated expiration known as a front month expiration while simultaneously going long or purchasing the same strike, call or put at a future dated expiration. The idea behind running a calendar trade is that you have a bullish or bearish longer term outlook on an underlying security, yet in the short term, you have a neutral to slightly opposite outlook in respect to the directional bias. Ideally, you want to be long an expiration that has a lot of time on the expiration cycle, meaning more than 120 days until expiration, and short an option that is 45 days until expiration, buying to close or doing an adjustment at 21 days until expiration. How do we trade calendars? Imagine running a call calendar spread. You typically want to be slightly out of the money on the longer dated expiration, and by the nature of options, the shorter expiration at the same strike will be further out of the money on a percentage-wise basis. You want the stock to trade sideways with an upwards drift towards your strike. When selling the short option approximately 45 days until expiration, we are looking to capture theta decay between 45 days and 21 days until expiration, as theta decay is the most significant between this time frame. At 21 days until expiration, we will evaluate if it's in our best interest to close out the short profit or roll the short option to the next 45 day till expiration. Alternatively, you can look to open a new short call at 45 days until expiration at a higher strike than your back month, effectively turning the trade into a diagonal spread. Also known as a poor man's covered call, we will be going over that right here. What is a diagonal spread in options trading? A diagonal spread is much like a calendar spread. It is a combination of a short option at a closer dated expiration known as the front month expiration, while simultaneously going long or purchasing an option at a further dated expiration known as the back month expiration. The difference between a calendar spread and a diagonal spread is that the short option in the front month or the closer month is at a further out of the money strike than the back month. This means that we have more of a directional trade when compared with the calendar spread, as selling a further out of the money option always carries less deltas than options closer to or at the money. How do we trade diagonals? Diagonals are very much the same as calendar spreads in the sense that you're looking for cost basis reduction in the back month that you are long. The goal is that you are buying a longer dated option for much cheaper by selling a closer dated one and leveraging the characteristic of time decay being the most significant between 45 days until expiration and 21 days until expiration, which will result in you buying the longer dated option at a cheaper price than you would if you had just bought the long dated call loan, aka naked. I know that was a lot of words. Let's look into some live examples with actual risk profiles and actual trades that I have taken myself. Here I have the options chain pulled up for Citigroup, which is a stock that I've had a calendar position on open for about 25 days so far. This is the June 18th short front month contract that I have. I have a call calendar, so I'm short an $80 call. Like I said, I've had this trade open for about 25 days so far. So I opened it when this expiration was 46 days until expiration. It is now 21 days until expiration. I opened this trade when it was at a 226 debit, so I paid $226 per spread, and they are currently trading for $340 now. I'm gonna hold these that I have here. How you would set this up is you would go out 45 45 days until expiration. The closest expiration, that's 45 days until expiration. So you can either do July 9th and July 16th. So let's just go to July 16th. How you would set up a calendar spread is you would sell out of the money calls. Let's say the $85 call, because right now Citigroup is trading for $78.75. Just round it down a little bit, $78.75. So this is the at the money strike right here. So let's go to the $85 strike, which is 81% out of the money. So this looks like a great option to short in the front month cycle. Let's set this up here. So sell the 85. Right now it's trading for 96 bid, 101 ask. So in the middle of that's 98. And then let's go out to a later dated expiration, December 17th, 2021, and we would long the same $85 strike, paying a $2.72 debit or $272 per spread for this trade. What you need to know about doing calendars, though, is you can't just set them up like that, leave it alone, and you'll make money. What you have to look for is what's called implied volatility skew. So what you're looking for is on this right side, I am using Tastyworks brokerage, and they have all these tools to your disposal for options trading. This is a very options-centered brokerage. But either way, every brokerage account, I should say, has a similar options chain. So what you want to do is you want to pay attention at these two things. You want to be selling implied volatility in the front month at a 2% skew or higher. What I mean by that is you want to be selling when this number right here, this 28, this is IV index for this expiration. You want to be selling this with 2% more than your back month. So if I'm shorting this expiration here, let's use our example. If I'm shorting this expiration here, I want the back month to have 30% or less, because that means I have a 2% skew. This means that I'm selling a call with a higher implied volatility. There's more premium in that option for that expiration than the back month. Back month options are affected more by volatility than front months. That is a characteristic of options. So I want the back month here to be 2% or less. So if I were to set that up, it wouldn't particularly work out because there is no option that is a longer dated expiration that has 2% or more skew. So I would not look to open up this trade. So on this Citigroup calendar trade that I've had open for 25 days, it is currently 21 days until the expiration of the front month contract. So I sold this option at 46 days until expiration in that option cycle. Right now they're at 25 days in. I've had this trade open for 25 days. I opened them for 81 cents credit, and right now they are trading for 118 bid, 120 S, so about $119. So right now I'm currently down on this trade on them, but I also have a 65% probability of profit, about 4 thetas that I am positive. So I'm making about $4 a day on this trade. I'm making about $4 a day on this trade as time passes and as these options, as this spread decays in value. So let's see what that would look like in a risk profile. So this is the risk profile of this trade, and let's pull up the evaluate at date feature on Tastyworks. So right now it is May 28th, 2021. Let's see what it looks like next Friday. So next Friday will be the 4th. So this is what it would look like from today until the 4th. So right now we are sitting at PL theoretical open of $254, just about. In 1 week, we will be sitting at about $298 P&L open if everything stays the same. That's assuming that Citigroup doesn't move, but it will move. So this is why we have this risk profile that can just show us the ranges of which we are profiting on this trade. And then let's fast forward a bit more into the expiration date of the front month, which is the June 18th expiration. So let's see what that would look like. And boom, that is our risk profile graph. On the date of expiration of the front month, you'll see that we are profiting between the points of about 72.5 and about 87.5. So here I have Snapchat pulled up, which is going to be my example for a diagonal spread. So here you see the July 2nd expiration, which is 35 days out. So I go down into this options chain. I opened this when implied volatility on this options chain was much higher for this option. I opened this when it was at about 48, right here, 48% IV, and now it is 44.83%. And this one when it was about 44, so it about inverted right now because this is at about 44, a little bit more than 44. This one's at 48 now, so it kind of inverted. But basically, I'm selling the $70 call here, but at the same time longing the 65 call here. Let's move over into the risk profile to see how that would look for our profits and losses. So boom, here we go. Here's our risk profile. Right now we are at a little bit of profits right now. We should be at about, oh, this is evaluating at the June expiration from before. So let's see what it's at right now. There we go. That's a much better. So theoretical P&L about $154 right now, P&L open. So let's see how this would look as time progresses because options are decaying 100% of the time, all the time. So let's see how that would look in the future. So as you see, our profit and loss graph gets more and more steep as it becomes more and more of a directional trade as you approach that June 2nd expiration. At expiration, the risk profile looks like this. Making profits if Snapchat is above approximately $60 per share, which is about a 54.4% probability. Obviously, we know it's a lot higher than that because we sell the option in the front month with a higher implied volatility than the back month, giving us more value in that option in the front month and putting ourselves in a great probability of profit. And let me pull over here the theta overlay in the Greek P&L graph. You can overlay some Greek analysis on your risk profile. So let's see how that looks like going back to today. So as you see right now, this is where our where Snapchat is at right now. And as you see here, our theta is about $2.50 a day. So we're making money every day as time passes. And let's pull up the time analysis again. So yeah, theta keeps going and going. It stays constant. And you know, at about the June 18th, our thetas have gone up quite a bit. So you're making more and more money as time passes, putting yourself in a great position to profit. That's all I have for you guys in this video. Hope to see you in future videos. If you like this, please leave a like, share, subscribe, and follow. Thank you all for tuning in. Hope to see you back next time. Happy trading.